What inspired you to get suddenly so introspective over the past couple of days?
Well, that happens once in a while for me. You know, I would say that the word lucky probably is inappropriate. It's certainly fortunate, and I think all of us in the investment world, those that have persisted for 10, 20, 30 years have been fortunate. But my point is it's not just Bill Gross in the mirror or Warren Buffett in the mirror or any other renowned investor. The outlook really speaks to the market in the mirror, both stocks and bonds, Adam, and that observes that both have produced rather epical, and that's key, epical, and extraordinary returns over the past several decades due to credit expansion and the decline of interest rates to near zero. Other influences such as globalization and the favorable tailwind of demographics, but all of these in combination may now be changing. And so my point is that if any investor wants to achieve greatness in the future, they should be aware of the potential shifts in the wind. And it's not just going to be like it has been for the past 30 or 40 years.
I like how you sort of assessed your own career in this piece, Bill. It almost sounds as if someone who's getting ready to step down. Is that what this is about, or is this about speaking to something broader, an inflection point really in the broader markets?
No, it's not hopefully the end like Michael Jackson in terms of stepping down or stepping out. You know, it's a question of looking in the mirror and trying to assess the potential for investing and for markets going forward in terms of their returns. You know, I hope to be around for 40 more years in terms of a career. I don't expect to, but I expect to be around for some time, and to be able to gauge a potential transition, and that's the key, a potential new epic in terms of investing, where we start with near 0% interest rates as opposed to 14.5% interest rates, Sarah, in 1981. You know, it calls for a different perspective and perhaps a different way of investing. And so I'm looking in the mirror, Pimco's looking in the mirror as to a potential change in terms of how we invest for our clients.
And Bill, when you look in the mirror, what do you see?
Well, we see that many of the structural influences are changing. It's obvious that interest rates are close to zero as opposed to 14.5%. It's obvious that instead of a young demographic in the United States with, you know, new families and new houses and cars and appliances, that we have an aging boomer demographic where much less of that is taking place, and certainly on a global basis the same conditions. We have a structural condition in terms of global where countries continue to take labor away from developed countries such as the United States. And so, you know, what we see is a world in which reflation, evidenced by the Bank of Japan last night, you know, has much more of a potential as opposed to disinflation, which has been the rationale behind the tremendous upward movement in asset prices over the past 20 or 30 years.
Let's talk a little bit more about this bold new experiment from the Japan and the Bank of Japan overnight, which you mentioned. Clearly investors were impressed, but is it going to work? Is it going to really be able to end the persistent deflation and stagnation in Japan?
Oh, that's a great question. We've been talking about that for a long time, but for 3 hours, an investment committee, Mohammed's still up there chairing the investment committee. We're still discussing the topic, and it's the pertinent question, can they do it? You know, they have an objective of 2% over the next 2 years. It seems not unachievable, but, you know, certainly a high target or a high bar to reach. In order to do that, primarily, Sarah, they've got to depreciate the yen, and yes, they've done that, you know, to the tune of 20% over the past 3 months or so. But to our way of thinking, you know, much more depreciation of the yen has to take place in order to get anywhere close to 2%. And, you know, would that be permitted, quote unquote, by the G7 countries in terms of their own, you know, particular environment? No country wants to get depreciated against, so they've got to control it to some extent. So, you know, we think the 2% target is a little bit unrealistic in terms of the 2-year time frame, and perhaps even over a longer period of time. It takes a very weak yen, and I'm not sure that other G7 countries are willing to permit that.
So a sea change in Japan, and I'm curious, Bill, whether there's a sea change at Pimco. You start with the lyrics of the song atop your essay. I'm starting with the man in the mirror. I'm asking him to change his ways. Is there a change in the process, your process, the way you're looking at the world right now?
Well, the way we look at it is from the starting point, I suppose, and then moving forward. And as I mentioned, the starting point in terms of, the high-quality sovereign bond yields is certainly close to zero, and that would be German bonds, Treasury bonds, and UK gilts. And so, from that perspective, it's one of not looking down in terms of yield going forward or prices moving upward, but certainly the possibility of prices going down and yields moving upward over the next 5 to 10 years. And so, it basically calls for a more defensive posture as opposed to an offensive posture. What I mentioned in the outlook was basically that most successful investors like Buffett and Soros and Gross and Dan Fuss and others have been, relatively aggressive investors over the past 20 to 30 years. Perhaps now it's time for the defense to take over and to begin to preserve capital as opposed to expand it at a double-digit rate.
So with that view, Bill, if you look at the 10-year Treasury yield right now, 176, we've heard you talk about the lack of returns in bonds for a long time, the boiling frogs, you name it. Do you have to stay in the safety of U.S. government debt, and how much do you allocate to that position?
Well, I think you do for the moment, and I think it's safer, at least for the next 6 to 12 months, because of what the Bank of Japan has done. Basically, the BOJ has gone all in terms of the amount that they're going to be buying, and to a certain extent, Sarah, that money now is expected to move out of Japan into Treasuries and into other high-quality markets at higher yields. Yes, the 10-year Treasury is only 1.75%, but it's certainly much better than what they can get in Japan. And if the yen is weakening, that's sort of a double play for Mrs. Watanabe, so to speak, which is the metaphor for the Japanese retail investors. So, Treasuries may be ridiculously priced and under yielding, but for the next 6 to 12 months, because of what's taking place on a global basis, there probably has some decent protection. That doesn't obviate what I said about the man in the mirror and the future going forward for the next 5 to 10 years. But for the moment, they have decent value relative to some of the alternatives.